Good day to one and all. I'm Christopher Ng Wai Chung, and today I'll be talking about satellite portfolios with dividends. And this is part of a series where I talk about the death of the Singapore dream. Okay, all right. And for today's presentation, we will be focusing on satellite portfolios. All right. What do we mean by satellite portfolios? That means portfolios that complement a core portfolio. And in part 3 of this series, I've spoken about two sample ETFs. All right, a bond and a stock ETF. And with these two simple ETFs, you can actually form the core of your retirement plan. All right. Now, a lot of investors obviously want to go beyond the idea of investing in ETFs, and they want to experiment with a particular theme. All right. So today I'll be talking about a very common theme that is a favorite for conservative investors, where we complement this core portfolio with some dividend stocks in the hopes that we are able to get slightly higher cash flow moving forward. All right. Yeah, for the people who want to understand a bit about how these satellite portfolios work, remember that satellite portfolios are what it is. They complement the core portfolio. So we should keep the satellite portfolios small relative to the core portfolio. So that would take up about 20% of the portfolio that you have. All right. So yeah, so that basically summarizes what a satellite portfolio is. And so for today's overview, we will be building a satellite portfolio with dividend stocks. All right. So I'll begin with some basics on dividends investing, and then I'll talk a little bit about the motivation behind dividend stocks, and explain a little bit about withholding taxes and why they matter so much for dividends investors. And then I will just focus specifically on the Singapore stock market. We will talk about using a simple brokerage account to pick up some blue chips, REITs, and business trusts. All right, so this should be a relatively simple kind of presentation on how beginners can actually get into dividends investing. All right. Okay, so let's begin with a discussion on dividend basics. All right. Yeah. So if you look at the stocks that are listed on SGX, right, occasionally you will be able to find a particular dialogue-looking kind of bubble after the stock name. And if you were to hover your mouse on top of this bubble, you will find that there is this term that says "cum dividend" or "cum distribution," right? And then what you do is that you drill into the stock, right, and you look at the dividend record. You will find something that mentions that, for example, there is an X date, the record date, and the payment date. It says that dividends is on its way. Okay, all right. And what is the meaning of these dates? Okay, now here's an example for anyone who owns Singtel stock. All right, right up to the 2nd of August 2022, if you were to buy the stock before then, you will be entitled to 4.8 cents a share. All right, and it says here that the payment date is on 18th of August 2022. Okay, so it means that if you have 1,000 shares, you will have $48 sent to your bank account if it is linked to your CDP. And if you have a custodian account, your cash account will increase by the dividends issued. All right, but for a custodian account, like interactive brokers, you have to actually inform the broker if you wish to withdraw from it. All right, yeah. So this is how you actually find out when your dividends are arriving. Okay, so in this case, for stocks that you own right up to the 2nd of August 2022, okay, you will receive 4.8 cents per share that you have. All right. If you were to purchase a stock on the 3rd of August, on the X date and later, right, you will not be entitled to the dividend. All right. So this sort of gives you an idea about how to read information on incoming dividends. All right. Okay, now there are some more basics that you need to know about dividend stocks, and I'm going to go through it now. All right. The most important thing you need to understand for rookie investor is the concept of a concept of a current yield. And the current yield is a measurement of how much dividends you would have received if you have held the stock for the previous 365 days. All right. And in order to calculate that, you can get to the same dividends page on the SGX website. And all you have to do is you sum up the dividends that have been given out for the past 1 year. So in this case, for Singtel, I note that it has given a dividend on the that will be given out on 18th of August and on 10th of January. So these two payouts basically span a period of approximately a year, right? And what you do is that you can sum up the amount of dividends you would have gotten in this time. So 4.8 cents plus 4.5 cents is basically 9.3 cents, okay? And to calculate the current yield, all you have to do is to take the amount of dividends that you would have received for the past year divided by the current price. And in this example, the current price is $2.66. And you can see that at least for Singtel, your dividend yield is 3.49%. All right. And I think the message for current yield is that for us dividends investors, we want the current yield to be as high as possible, because the higher it is, it means that it generates more cash flow for you throughout the year, and you get more money to sort of pay off and offset your basic expenses. And the beauty of it is that the dividends would actually arrive into your bank account, even if you are in a coma, resting in a hospital, right? And so this is actually a very, very much preferred form of investment for more conservative or perhaps the more elderly kind of investors, right? Now I'm going to next talk about motivation behind investing in dividend stocks, okay? And what I'm showing you here is that dividends tend to do much better in a downturn in the market cycle. So as you can see on this page that I have, when the stock market is going through a downturn, right, you will find that under downturn, the horizontal row, and dividend yield, which is the vertical column, you find that dividends outperform by about 0.71% during a downturn. And so dividends fare very, very well when we are going through a process of falling into a recession. And this actually allows investors to actually take the amount of dividends that they've received and allow them to pivot into riskier small cap kind of investments when the markets finally recover from a recession. So the motivation behind dividend stocks is that we like dividends not just because of the amount of money that it puts into our pockets, but also because dividend stocks have a tendency to outperform when times are bad, right? And when times are bad, the desperation for good news is actually a lot higher. So you find that the people who have invested in dividends actually tend to do very well when there is a market rout, right? Among the technology investors. Like actually what's happening at a time where the video is being made, we are in the middle of a downturn caused by not just COVID, but the war in the Ukraine, as well as rising interest rates. And in this period of time, the hand of a dividend investor is stronger than ever. All right? Yeah. And so if you think about it, right, dividends also have the ability to assist people who are very much in the financial independence and retire early kind of movement, because it provides a regular payout, right? And that can be extremely motivating. And if you were to generate a dividend portfolio with a current yield that is above the 4% safe rate of withdrawal, you can attain your financial independence objectives much earlier. So for example, if you need $1,500 a year to cover all your basic expenses, at a 4% rate of withdrawal, you need $450,000 to offset all your expenses. However, if you can build a portfolio that spins off dividends at a current yield of 6%, then you only need 18,000 divided by 0.06, right? Your denominator goes up. And so you only need 300,000 to offset all your living expenses. So you reduce the effort you will need to attain FIRE by up to 33%. All right. So that's really a very, very strong motivator for people who are, for example, stuck in extremely toxic kind of workplaces, and they want a way out, right? So this becomes an extremely strong motivator. Okay. Now I'm going to talk about now a major consideration that you need to think about when you actually invest in dividend stocks. Okay, for investors that are domiciled in Singapore, I've got a table that generally just talks about the kind of withholding taxes that you will need to pay, all right? And of course, the details you will need to consult a tax specialist. So I've basically listed out the withholding taxes in the majority of cases, all right? And the first row says United States at 30%. And this is the reason why, if you are focusing on dividends, right, it might not be a very good idea to buy dividend stocks in the US, because when the dividends arrive, 30% of it is taken away from you, all right, to pay Uncle Sam, right? And that's something which it would lower the amount of current yield that you effectively have, right? If you were to invest in Bursa Malaysia, the withholding taxes is 10%. In Australia, it is 15%, but a lot depends on whether the dividends are actually franked, all right? And that's something which you might want to do a little bit more investigation into Australia. So not everything attracts that 15%, and the rates vary. Hong Kong and Singapore are the best places to invest in dividends because the withholding taxes is zero. Okay. Now do note that the numbers I've taken for this table is done on the best effort basis and is dated 18th of July. Right. So because of this, right, I strongly recommend that people who want to begin investing for dividends would just spend a little bit more time looking at dividend stocks in the Singapore stock market, because Singapore stock market is known to be very boring, but known to be extremely stable. And we've actually seen a record where the Singapore stock market has outperformed the rest of the world when there is a collapse in tech counters. So Singapore very much is dividend land, all right? And there are a lot of elderly investors that have survived many market cycles investing in dividend stocks, and they are totally happy with their kind of performance, all right? And if you do the sort of back tests very often on Singapore blue chips that give a higher dividend, you find that the returns beyond like a period of a decade, right? If you hold it for a decade, your average returns would be between, I think, 7 to 10%, which is actually a very stable and a very respectable kind of return, right? That covers both dividends as well as capital gains. All right. So for this section of the presentation, I'm going to talk about 3 areas that I think that a rookie investor can look into. The first are Singapore blue chips, all right? The second is Singapore Real Estate Investment Trust. And finally, Singapore Business Trust. All right, so let's jump in and talk about Singapore blue chips. Okay, now Singapore blue chips, all right, they're stable, tax advantage choice, very suitable for older investors. It's very easy to get information on this class of investments from mainstream media because you read about it every day on the Business Times. Counters are also heavily followed by brokers who publish a lot of analyst report on these various blue chips. Okay, and if you have $1, you can actually just buy a copy of the Business Times and just mark out the stocks that give you the highest dividends. Now, what I'm going to show next is something which I found from the Business Times. So the weekend copy of the Business Times has a table that lists out the Straits Times Index component stocks. And one simple exercise that you can do is to take a highlighter and just highlight every single blue chip that gives more than 4.5 or 5%. In this case, I've highlighted those that's given more than 5%, and I've actually marked them to create a very basic portfolio of about 7 counters. All right, so this is something which a lot of beginners can do. You've got $7,000, you can split it into 7 parts, put $1,000 into each of these counters, and you instantly have a beginner's portfolio that gives you more than 5% a year. All right, and so this is something that can be done with a newspaper. Okay, so this is easily something that anyone, even some people who are not internet savvy, can actually try. Now, within the subset of STI blue chips, obviously I got to talk about the biggest component, which are our local bank stocks. All right, so our local bank stocks, consisting of DBS, OCBC, and UOB, combined together, they take up 45% of the STI index. Okay, and bank counters is something that you should include in your portfolio because it does well when interest rates rise. okay? And basically, banks are very simple businesses where you get people to deposit money in your deposit accounts, and then you lend the money to another group of people that need to borrow money. All right, and you can earn a certain amount from it, okay, and that is determined by a number called the net interest margin. All right, and when interest rates rise, net interest margin would also rise. So bank stocks are the stocks that generally can remain stable or will do well when interest rates is being clearly being increased on a regular basis by the Fed. All right. Now you need to, of course, when dealing with banks, spend some time reading on the newspaper and watch out for things like how are their wealth management fees doing and whether they are being hit by non-performing loans. Okay. Yeah. But when it comes to all these details about investing in banks, right, this is something where your expertise should be developed over time. All right. You're not going to develop this overnight. But being a banking investor, it will make you more alert, all right, to what's basically been happening around the banks. Okay. All right, so I'm going to talk about a good place to start, which is OCBC. The ticker symbol is O39. When the slide was created, it was giving 4.6% dividends, right? And banks have a very stable beta around 1, all right, which means that it moves up and down with the rest of the stock market. All right, you can replace OCBC with any bank, DBS or UOB, it's totally fine, okay? And OCBC Bank pays twice a year and tends to do better when interest rates are rising. Okay, so it's a very, very easy way of getting a basic understanding of what banks are like. All right, so we conclude our section on banks. All right, and now we move on to real estate investment trust. Okay, and real estate investment trust basically allows you to act like a landlord. All right, you are collecting a regular payout either twice a year or 4 times a year. Okay, and to get a greater understanding of real estate investment trust, weekly investment periodicals like The Edge Singapore can provide a snapshot of the REITs market. All right, it's as simple as buying a weekly magazine, reading it, all right, and then you can basically start to get some valuable insights on what's actually happening in the Singapore real estate market. Okay, now here's a sample of what I've taken from The Edge. Okay, and they have a column that actually tells you what current yield you will find when you buy a real estate investment trust. Sorry, it's a little bit blur, the screen, but you can find easily some US office REITs can give up to even 10%, right, a year. Okay, yeah, because investors are willing to take on a little bit of forex risk and there's a misunderstanding of the market opportunities in foreign markets, right? You will find that the real estate investment trusts that focus on European, US property tend to give out very, very attractive dividends. So that's something that you can look at and you can regularly find, okay, when you get a copy of The Edge magazine. All right, so it's something that you can start doing. Okay, and let's talk about a specific REIT. Okay, and one of the iconic REITs in Singapore is Ascendas REIT. The ticker symbol is A17U. When the slide was created, it was yielding 4.6%. The beta is 0.38. So this is one of those classic counters that you will find that has a very low volatility compared with the rest of the Straits Times Index. All right, so you buy a Ascendas REIT because you want stability. Okay, and it also has a tendency to do better when interest rates are falling, okay, which is the opposite of the bank stocks that I'm talking about. Ascendas REIT pays twice a year. Over time, you can add on REITs like those from Capital Land, Parkway Life REIT, okay, as well as very useful industrial REITs like AIMS, APAC REIT into the mix of REITs that you have. Okay, and so we're done with the REITs discussion. And no discussion on dividends is complete without a discussion on business trusts. All right. And business trusts are less well-known instruments that generally cover yield-based instruments. Okay, and most of these assets are in the hospitality segment. So most of our hotels and hospitality trusts, they are hybrid instruments. They are both business trusts and they are also REITs at the same time. Okay, but legally, the business trusts and REITs, there are very subtle distinctions between them, all right, to which we can talk about, right? Now, when you buy a REIT, the trustee and the manager are different entities. You can remove a manager with 50% of the votes. 1/3 of the board must be independent, And REITs have a maximum gearing of 50%, which means that for $1 million worth of property, you're not allowed to borrow more than $500,000, all right, within a REIT. And you must pay out 90% of your cash flow as dividends, right? So REITs have done very well, all right, with this regime that is very favorable to people that love dividends. Okay, REITs have basically taken off and made Singapore a global hub for real estate investment trusts. The less known brother is the business trust, which is slightly different, right? The trustee also manages the property. Management is entrenched, and you need 75% of the votes to remove a manager. The majority of the board must be independent. There is no maximum gearing, and there's no payout condition. So if you were to invest in a business trust, in essence, right, you're taking, I think, slightly more risk than getting into a real estate investment trust. Right? So over time, I would say that the business trust regime is not as popular, does not attract as many new listings as real estate investment trusts. Okay, but in particular, I want to single out a very good business trust that most beginning dividends investors might want to consider for their portfolios. Netlink NBN Trust is spun off from Singtel, and it's a business that allows you to actually own and rent out the fiber that you have in Singapore, right? At the time the slide was created, the yield is very high, 5.2%, with a very low beta of 0.4, which means that you're only taking 40% of the market risk compared to someone that's invested in the STI. Okay, the advantage of Netlink Trust is that it's exceptionally stable. It survived the pandemic. It currently pays about twice a year. And what's interesting is that it pays in quarters when Ascendas REIT does not pay a dividend. Right? So over time, you can add counters like Asia Pay TV, HPH Port Trust, and other business trusts into your mix. But generally speaking, conservative investors have all been very, very open about their love for Netlink NBN Trust. Okay. All right. So we've basically come to the conclusion of our presentation for today. We've looked at dividend stocks. They are sufficiently robust and defensive. In fact, I would say that it forms a core portfolio on their own. All right, my core portfolio is actually in dividend stocks. All right, but in this particular presentation, we want to look at dividends investing as a satellite kind of portfolio. All right, it generates high passive income. It can shorten your journey towards financial independence. It has a tendency to do better than the rest of the stock market in a market downturn. Specific to Singapore stock market, you can look at dividend stocks like REITs, right, that present serious tax advantages for the investor, right, where there is no tax levied at the corporate level and no tax levied at the personal level. All right. So we've come to the end of our presentation for part 4, the death of the Singapore dream. All right, and you can incorporate dividends investing into your new Singapore dream, okay? All right, and I think that has done a lot of good for me and my family. And a preview for part 5, we will be looking at growth investing in part 5, all right, and how we can create a satellite portfolio of growth investing counters, all right, as we move on in our journey to understand a lot more about the Singapore dream. All right, this is Christopher Ng signing off. If you like my material so far, please subscribe to my channel, okay, and I will see you soon for part 5. Thank you very much.